we just ran the numbers this morning in terms of forward earnings estimates, and a bit of a surprise to see a pickup in Taiwan, South Korea and China. So it's not just all froth and bubble in that Chinese market. It's obviously performing really well. But yeah, sort of a little bit of valuation been priced into that market. It's on about 20 times forward earnings now, Matt. So probably a little bit too rich for our blood. Probably prefer to buy other stocks in the region than China. It just seems to have gone up, too far, too fast, if you like. And obviously having a little bit of a breather today with the rising trade tensions.
Yeah, you're also taking an underweight position in growth assets. It was interesting. Yesterday we had a guest that said he was targeting growth over value.
Yeah, so growth assets in terms of equities versus bonds as opposed to growth shares over value shares, although there is a fair bit of rotation happening. Look, there's a number of managers out there who say, look, there's no point buying bonds here because the yields are just too low. We just think the equity markets hasn't priced in some of the risks. Just listening to your reporters in the past 5 or 10 minutes, it's all about the risks that are emerging, whether it's the coronavirus, whether it's secondary lockdowns, whether it's the tensions in the South China Sea. There is actually still quite a lot of risk in the market. The fact that the VIX went back up in the US last night, back up over 30, suggests there's a lot of uncertainty in the market. Well, we think at 20 times forward earnings, which is where US, Chinese and Aussie equities are trading, there is not a lot of risk premium being built in. So we think there's better risk premium in the credit market, so we can pick up some 4 or 5% yields from some decent corporates. We're not looking at those sort of yields in the equity market. So just not moving massively underweight growth assets in terms of equities, but just sort of taking slight underweight position, moving a little bit of money to credit. It seems like the right thing to do right now.
Martin, it's absolutely fascinating, isn't it? Because as you pointed out, there is some building risks in these markets. You mentioned them, the renewed virus surge. You've got geopolitical risks also playing out, as well as great uncertainty about valuations now too. What would it take for Asian equities to start accurately pricing that risk? How much further do they need to come back, in your opinion?
Yeah, it's different across the markets. Obviously, Taiwan and South Korea really are tied into the sort of semiconductor industry, so they kind of need a recovery in business spending, and it's really hard to see that given the uncertainty. I mean, as we know, we're heading into reporting season in the US, and I think CEOs are going to be very gun-shy in terms of talking about investment and forward bookings and those sorts of things. So I think some of those markets will really need a kick in the semi industry. Other markets really comes back to how much stimulus has been put in place. We know in Australia we've only got a small health crisis. I mean, it feels big, but relative to some other countries, it's a small crisis. Yet we've stimulated almost 10% of GDP in terms of fiscal spending, bailouts, etc. So a lot of Asian countries are probably half that level. So probably needs a bit more government stimulus and a little bit of more certainty around the capex cycle to see some of those markets start to move higher, I'd say, Dan.
And Martin, when it comes to the geopolitical outlook as well, I know you follow this quite closely. We've seen significant pushback now from the United States with regards to China's attrition in the Pacific. The South China Sea tensions continue to build. Do you see this as a material risk to your strategy?
Yeah, I think that and the US election are probably the two risks that are starting to emerge and starting to get a bit more focus. And whether we're just getting sick of coronavirus stories, I mean, it's just been, almost 6 months now, and, maybe we're just getting tired and we want to talk about something else. But, I think the fact that the US is sending a couple of aircraft carriers to the region, yes, it's just for exercises, but it's clearly saber rattling. Some of the, comments from Pompeo are obviously quite inflammatory. So this thing's not going to go away. China hasn't really backed down at all from any of these disputes. So I think that's going to emerge, and that's going to probably meld into concern about what a Joe Biden White House looks like and whether or not, tax increases for corporate America are going to knock the market around. So I think, we're sort of priced on the back of the $11 trillion of fiscal stimulus that's happened. We're not really priced for some of these risks. So I just think, we're being cautious. We'd probably use any further strength in equity markets to trim that underweight even further.